happened at Signet Jewelers, SIG, #1 specialty jewelry play in North America. You might recognize them as Kay Jewelers or Jared or Zales. Here's a stock that's fallen more than 20% from its highs in October, and it's down 6% for the year to date. But after taking it on the chin for months, Signet's rebounded pretty dramatically from the market-wide lows in mid-February, which begs the question, has the stock finally gotten its groove back? We know that Signet reported a decent quarter a couple of weeks ago. Company delivered a 4-cent earnings beat off of a $3.59 basis, even as their sales were a bit weaker than expected. But they had a healthy 4.9% increase in same-store sales. You know that's the key metric for retail. And management gave you solid guidance for the full fiscal year, not to mention authorizing a substantial $750 million buyback. So is this jewelry colossus worth circling back to at these levels, particularly after it pulled back nearly $4 today on nothing I could see? Let's take a closer look with Mark Light. He's the CEO of Signet Jewelers. Find out more about how his company's doing and where it is headed. Mr. Light, welcome to Mad Money. Good to have you, sir.
Thank you. Great to be here.
Mark, it's the first time we've had you on, so people know your brands. I just want you to walk through how you make your money on the brands and the different levels.
Well, thank you, Jim. At Signet Jewelers, first of all, we're the largest retailer of diamond jewelry in the world.
Okay.
And our largest brand is Kay Jewelers, which is the largest brand in the United States. And then we have Zales Jewelers and Jared the Galleria Jewelers. We're also the #1 jewelry brand in Canada with People's Jewelers, and we're the #1 and 2 jewelry brands in the United Kingdom with Ernest Jones and H. Samuels.
Okay, but when I go through the conference calls, there's a couple things that tell me that are interesting. Styles matter. The commodity costs, people say, matter, and also the seasons. So are we in an important point? I know Valentine's Day is important. I mean, it's a seasonal business to some degree, but walk me through the key metrics along those lines.
Sure. Well, our business is about 50% gift giving, which ties into the seasons, Christmas, Valentine's, Mother's Day. And our other 50% is a bridal or engagement related business.
Okay.
And that is a nice consistent business that we have, and it's a very stable business. It's the closest thing we say to a necessity that we have. So that bridal business is a very solid business for us and very consistent business.
Now, you had traditionally had some debt on the balance sheet. You bought Zales, and you took down a lot of debt. How is that acquisition doing? Because I know you've had some synergies, but you still have a lot of debt, and you're doing that buyback.
Yeah, well, the entire debt that we have is specifically for the Zales acquisition, and Zales is doing very well. We just increased our synergies that we share with the market up by 50%, up to 225 to 250 million direct improvement in the bottom line profitability, and we're thrilled what's going on with the acquisition and the integration of Zales with our company. Okay,
on the conference call, you spent a lot of time trying to go over lending standards, basically. You have an element of your business that's kind of like a credit card company. What are the risks there for people who are interested in investing in Signet, and how do you balance the risks for customers who definitely want to buy jewelry because you got to get a wedding ring but can't afford it?
Yeah, in our Kay and Jared stores, we've been carrying internal credit for well over 30 years, Jim. This is something we've been doing for a long, long time, and it's something that we have a consistent methodology of how we approve and underwrite our credit business, and we literally have tons and tons of data understanding how jewelry customers react to credit and how they pay for their credit bills, which is different than how they pay for their cars. So our credit portfolio is doing very well, and we think it's a tremendous enhancement to our business.
How did it hold up during the big downturn, the Great Recession?
It was the statistics or the metrics were worse than they were during outside the recession, but they were much better as we compared to other financial institutions. So we have a very good handle on how we run our credit business.
Next Wednesday we have retail sales, and the last retail sales number not only was bad for the previous month, for February, they revised things down for January. How's Signet doing? Because retail sales have been so rocky in the country.
Yeah, well, Signet's been we've been pretty consistent. If you look at Signet over the last 20 years, we've been consistently up 5% and outpacing the jewelry market. We just gave guidance for our first quarter, and we guided that we will be up 3 to 4% for the first quarter.
Now, you've got some brands. I've been to Neil Lane, and that's very expensive in L.A., as a treat. And Vera Wang, not inexpensive either. Do they fit into the level of income of people who go to Zales and to Kay?
Well, that's the beautiful thing about Neil Lane and Vera Wang Love collections. They design products for the celebrity levels, but they're also designing for middle America, and that's what we're all about, Jim. We are the best jeweler, and we know the mid-market better than anyone else. And that's why we're a growth company, quite frankly. So yes, brands like Vera Wang and Neil Lane have done tremendous because they're designing products for middle America, and we're selling them through our Kay, Zales, and Jared stores.
Now, one of the things that L Brands had a restructuring today, and they've taught me well, be careful of the malls. Howard Schultz has told me, be careful of the malls. Do you think that brick and mortar malls are no place to be, even though I know that you can't be Amazon because of the way jewelry is.
Yeah, you know, in our business, jewelry is very much a considered purchase, very much considered. That people are buying engagement rings, they're buying gifts, it's considered. So we're more of a destination. So we're affected by mall traffic, but not as much as other retailers. And we see that there's different types of retail traffic. You have mall traffic, you have off-mall traffic, you have online traffic, and you have outlet traffic. And I know this is a common term used, but the omni-channel experience in jewelry is so critical.
Right.
And so we believe that there are good malls that you need to be in, and there are very healthy malls, but we have a very diversified portfolio. About 50% of our business, Signet, is off mall, and 50% is in the mall.
Okay, so you got it both covered. One last question again, because I want people to understand, first time on.
Please.
Your relationship with credit, is it similar to what, credit card companies, except the fact that there is some loss, but they do well? I mean, net out good. I mean, you net out good on your credit.
Absolutely. We net out good. We believe it's a tremendous enabler, and we understand these customers. We understand the jewelry customers better. We've been lending money to jewelry customers for 30 years. So we have a lot of tremendous data to understand how they pay for their jewelry. So yes, it's a very, very good program for us.
Excellent. Well, thank you so much, sir. That's Mark Light, CEO of Signet Jewelers. You've seen the ads. Now you can learn the story. And I want you to stay with Cramer. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.